So this question tells us that Parker Corporation, they own 10% of the outstanding common stock issued by Valar Corp. So in year 3, Valar Corp, they generated $200,000 of net income and they distributed a cash dividend of $250,000. All right, so if we read through that without really thinking, that sounds completely normal, but take a second and think about it, right? They only generated net income of $200,000, yet the cash dividend was greater than the amount of income they generated that year, right? It's $250,000, which means an extra $50,000 of cash was paid out at a dividend that related to earnings from a prior period. So there's this rule that if a company distributes cash dividends in excess of the net income they generated that year, well, that's a liquidating dividend, that excess amount, right? Because they're essentially just taking earnings from the prior year. It wasn't generated in the current year, right? So that's why the excess portion is considered to be liquidating. And that's important for Parker Corp because that impacts how they record the dividend in their own financial statements. So let's do a quick breakdown of this dividend for Parker Corp, right? So everything's at 10% because the numbers they give us were for Valar in total. So that total cash dividend, well, 10% of $250,000, that's $25,000. So that's the amount of cash they received. Now the non-liquidating portion, which relates to the actual net income that was generated, right? Well, 10% of that would be $20,000. So that's what they received. That would be a non-liquidating dividend. And then the liquidating dividend is that excess $5,000, which is basically the difference, right? 50,000 times 10%, that equals $5,000. So that's important to understand because we know that the treatment of a non-liquidating dividend versus a liquidating dividend is different in Parker's financial statements. So we should recall from the lecture that the non-liquidating dividend, well, that gets recorded as dividend income, right? That's just ordinary income, and that's going to be $20,000. Now, the liquidating dividend, that is not going to the income statement. That reduces the carrying value of the investment in Valar on Parker's balance sheet, right? So when we look at the journal entry, well, we would debit cash because they received $25,000 of cash, but then the credit to dividend income is the $20,000 for the non-liquidating portion, and then the liquidating portion is that excess $5,000, and that's going to reduce the carrying amount of the asset for that investment on the balance sheet, right? So that's why it's a credit of $5,000. So now that we understand how this dividend can be broken out and actually recorded into the company's financial statements, we now see that it's only asking what amount of dividend income related to this investment would Parker record in their year 3 income statement. Well, it's not going to be that full $25,000, right? That might go in the cash flow statement, but dividend income is going to be the only thing that hits the income statement here, and that's only going to be $20,000. So $20,000 is the correct answer. It's a very tricky question if you don't understand how a liquidating dividend compares to a non-liquidating dividend. But just remember that simple rule that if the company distributes a cash dividend that is higher than the amount of income generated in the current year, the excess portion is going to be considered a liquidating dividend.